All right, welcome to The Explainer. Today, we're going to talk about a really powerful tool in the real estate market, one that's been hiding in plain sight but could seriously change the game for anyone trying to buy or sell a house right now.
I mean, just think about that for a second. What if you could walk out and buy a house today, but with a mortgage rate from back in 2021? We're talking 3%. While everyone else is looking at around 7, it sounds like a fantasy, right? Well, it's not, and it gets right to the heart of the affordability problems so many people are facing. But, before we get to this clever little solution, we really have to understand the problem. There's this gridlock happening in the housing market, a kind of trap that has both buyers and sellers completely stuck. And wow, this chart just says it all. This is what economists call the lock-in effect. See that blue dashed line? That's mortgage rates shooting for the moon. And look what happens to new listings and home sales. They just fall off a cliff. Why? Because if you have a 3% mortgage, you're holding a golden ticket. You're not going to sell and take on a new 7% loan unless you absolutely have to. That traps people in their homes and totally shrinks the housing supply. So what if there was a way to get around all that? What if you could just sidestep today's high rates by inheriting one from the past? It almost sounds like time travel, but it's a real financial tool that's just been collecting dust for decades. So here it is. It's called an assumable mortgage, and it's basically a financial time machine. A qualified buyer can literally take over the seller's existing loan. And I mean the whole thing. The original interest rate, the original terms, everything. You're essentially grabbing a loan from a completely different low-rate era. Okay, so you're probably wondering, can I do this with any mortgage? The short answer is no. This superpower is mostly found on government-backed loans. We're talking FHA, VA, and USDA loans. But that's not some tiny niche. It's about 23% of all active mortgages. Most of your typical conventional loans have something called a due-on-sale clause, which, means the loan is due when you sell, so you can't pass it on. And what's so funny is that this whole idea basically became a fossil. For decades, as you can see from the blue line here, mortgage rates were generally falling. So why on earth would you want to assume someone's older, higher rate loan? You wouldn't. It made no sense. And so the feature was just forgotten. And then bam! This chart just shows the moment everyone remembered. Look at that red line. That's Google searches for assumable mortgage. It's totally flat for years, and then it just goes vertical the second that interest rates start to climb. People were desperate for a solution, and they suddenly rediscovered this old tool. So this isn't just a lifeline for buyers. For sellers, that low-rate loan they're sitting on has suddenly become a hidden asset. It's like finding a winning lottery ticket in an old coat pocket. But what's it actually worth in today's market? Well, the research puts a pretty solid number on it. On average, a house with an assumable mortgage sells for more than $20,000 more than a similar home without one. That low interest rate has real, tangible cash value. So that extra 20 grand, where does it go? Does the buyer get all of it in savings? Not exactly. The data is really clear here. A whopping 82% of that hidden value goes straight to the seller in the form of a higher sale price. The buyer still gets a great deal with interest savings, but it's the seller who really cashes in upfront. And for sellers, it's really a double whammy of good news. Not only are they getting a price premium, somewhere in the ballpark of 5 to 7%, but their homes are also flying off the market. Selling about a week faster might not sound like much, but in a cooling market, that's a huge advantage. All right, I know what you're thinking. If this is so great, why isn't everyone doing it? Well, as you can probably guess, it's not exactly a walk in the park. There are some pretty significant hurdles for both buyers and sellers. One of the biggest problems is just friction. It's the system itself. As Craig O'Boyle from Assumption Solutions puts it, the loan servicers, the actual companies that have to process all this paperwork, they often don't even know how. They haven't had to do one of these in decades, and that can lead to huge delays and a lot of bad information. But, okay, the real elephant in the room, especially for the buyer, is something called the equity gap. Let's break it down. Say a house sells for $450,000, but the old, assumable loan only has a $300,000 balance left. That leaves a gap of $150,000, and the buyer has to come up with that cash because you can't roll it into the loan you're assuming. Now, how do you come up with a huge chunk of cash like that? Well, you've got a few options. You could pay cash if you have it, you could take out a second mortgage to cover the difference, or you could even get a personal loan. Sometimes a seller might even be willing to loan you the money themselves, which is known as a carryback note. But listen, each of these solutions has its own costs and its own headaches. Okay, so we've seen the pros, we've seen the cons. Let's zoom out now. What could all of this mean for the entire housing market? Could this little-known tool actually have a major impact?
And this data right here is absolutely fascinating. Just look at these two lines. The top blue line shows areas that have more of these assumable mortgages. In those places, when interest rates went up, new listings barely budged. Compare that to the bottom line, where listings just tanked. What this means is that these loans directly fight that lock-in effect, giving people the freedom to sell and pumping some much-needed supply back into the market.
And that brings us to the big final question, doesn't it? By giving people a real escape from the rate trap, could assumable mortgages be the key to getting the whole housing market unstuck and moving again? It's a pretty powerful idea that a financial tool from the past might just be what we need to unlock our housing future. This is not financial advice.